Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Hisense Home Appliances Group Co. Limited, latest report. Hisense Home Appliances Group Co. Limited offers a wide range of products and services across various categories. The company provides central air conditioning solutions both domestically and internationally. In terms of product offerings, Hisense engages in the research, development, manufacturing, marketing, and service of HVAC systems, refrigerators, freezers, washing machines, kitchen appliances, automotive air conditioning compressors, and automotive integrated thermal management systems. The company also offers full-scenario smart home solutions through both offline and online platforms. This comprehensive approach enables customers to experience a seamless integration of technology and convenience in their homes. Hisense's product portfolio is diverse, with its products being sold under various brands including Hisense, Ronshan, Kellen, Hitachi, York, Gorange, ASKO, and Sandon. Overall, Hisense Home Appliances Group Co., Limited, has established itself as a leading provider of home appliances and solutions, catering to the needs of customers worldwide with its extensive range of products and services. Hisense Home Appliances Group Co., Limited, market capitalization of $32 billion, is significantly larger than the average industry peer of roughly $0 billion. This shows that Hisense Home Appliances Group Co., Limited, holds a significant advantage in their industry. Hisense Home Appliances Group Co., Limited, trades at a lower price-to-earnings ratio of 7 times and a higher price-to-book ratio of 1.4 times relative within the industry. Despite the industry trading at relatively low valuations, the stock matrix does not show much. Investors should evaluate if the business has potential earnings that is sustainable and if the assets are valuated rationally. The leverage on the balance sheet appears elevated, with liabilities of 72% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 6.88%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth for the company can be attributed to several key factors. The launch of new products, such as the Yes Super III series and the Smart HVAC ecobee 2 system, has contributed significantly to revenue growth. Additionally, the expansion into key segmented industries and the introduction of water chiller products with positive pressure, liquid floating, oil-free platforms have also driven growth. The company's washing machine business has experienced rapid growth in global main business revenue, while the launch of revolutionary products, such as the Cotton Candy Ultra family drum, has been well received by consumers. The growing industry trend of growth in the washer category and accelerated penetration of large-capacity washing machines have also contributed to revenue growth. Furthermore, the company's offline revenue growth has increased by 43%, with mid to high-end product sales accounting for 60% of revenue. Breakthroughs in air conditioner technologies, strengthened collaboration with key global customers, and successful expansion into new markets have also driven revenue growth. On the other hand, the primary drivers of revenue decline can be attributed to a sluggish real estate market, which has led to a contraction in the mid to low-end segment of the home fit-out retail market. The operating revenue decreased by -5.19% compared to last year, while net profits attributable to shareholders of listed company decreased by -4.82%. The net income of the company underwent significant changes between 2024 and 2025. While it decreased by $392 million overall, there were notable increases in various regions. The North America region saw a +13% increase, while the South America region experienced a +28% growth. Similarly, the Middle East and Africa region reported a +9% increase, and the Asia-Pacific region saw a +15% rise. However, despite these regional gains, the net income also decreased by $336,877 in some areas. Nevertheless, when looking at the overall trend from 2023 to 2024, there was an impressive increase of $259,442,381. This indicates that while there were fluctuations within specific regions and years, the company's net income generally showed growth. In terms of profit margins, the operating and net profit margins decreased slightly from 6.1% to 6% and 5.5% to 5.3%, respectively. However, there were some notable exceptions. The Asia-Pacific region saw significant improvements in profitability, while certain product lines, such as refrigerators and washing machines, experienced increases in profit margins. The company's overall profit margins are also influenced by exchange rate fluctuations, which have led to narrowing profit margins in overseas businesses. Nevertheless, the increase in overseas revenue has contributed to an overall rise in profit margins. The company's financial performance indicates a strong ability to generate cash from its core operations. A review of various sections in the report confirms this trend. On page 1 and page 2, it is explicitly stated that the company has positive operating cash flow. Furthermore, on page 30, the net cash flow from operating activities is reported at 12.94%, which signifies a significant increase in operating cash flow. This is reinforced by the statement on page 32, reiterating that the company indeed generates positive operating cash flow. These multiple confirmations demonstrate the company's financial stability and its ability to generate sufficient cash from its core operations. The company's financial situation has undergone a significant transformation over the past year. One of the most notable changes is the substantial increase in interest expenses. In 2024, the company reported an interest expense of -$36.9 million, but this figure skyrocketed to $193.1 million in 2025. This dramatic shift is also reflected in the total financial expenses, which rose from -$36.9 million to $205.2 million. The data suggests that the company's debt level has increased significantly, leading to a substantial rise in interest expenses. The comparison between 2024 and 2025 interest expenses further reinforces this conclusion, with a staggering increase of over $43 million. This trend indicates that the company is shouldering a much heavier financial burden, which may have implications for its future operations and profitability. Management is emphasizing the need for a significant shift in the company's strategy. To achieve this, they plan to deepen omnichannel synergy by transforming the retail model into a more user-centric approach. This will involve upgrading full-scenario intelligent services and accelerating digital transformation through AI technology applications. The company aims to prioritize efficient and convenient user experience, which is reflected in their goal of building a full-scenario intelligent service system with an AI technology foundation. By doing so, they hope to create a seamless and intuitive experience for users across all touchpoints. Overall, management's vision is centered around leveraging technology to drive innovation and enhance the overall customer experience. The company has demonstrated its commitment to returning value to shareholders through two key initiatives. Firstly, it has paid dividends, as explicitly stated in multiple sections of the report. This indicates that the company is prioritizing shareholder returns and rewarding investors for their loyalty. In addition to paying dividends, the company has also engaged in share buybacks, a strategic move aimed at increasing shareholder value. The report highlights specific numbers associated with these transactions, underscoring the company's proactive approach to managing its capital structure and enhancing shareholder wealth. There are concerns about inventory buildup or supply chain disruption in the air conditioner industry. High channel inventory overseas has been observed, with a notable decrease of 2.3% in export volumes year-on-year. This suggests that there may be an overstocking issue in international markets. Furthermore, the manufacturing industry is facing challenges, with revenue decreasing and costs increasing across various product lines, including HVAC products. Additionally, domestic sales revenue has decreased, while distribution channel revenue has also seen a decline. These trends indicate potential supply chain disruptions and inventory buildup issues that need to be addressed. That concludes the financial summary for Hisense Home Appliances Group Co. Limited. Feel free to comment below, and I will be happy to answer them when possible.